All right. Welcome everybody to the Catalyst Funding November 2024 real estate market update. Just pushed us live on Facebook Live, as well as we're live for all of our guests that have been waiting for the latest information on the real estate market, especially the major metros in Texas of Houston, Dallas, San Antonio, and Austin. And to provide that, we have the industry experts that we like to bring and a special guest. So let me introduce to you our founder and CEO, Wade Comeaux.
Hello, everybody.
We've got our director of lending today, Jeff Johnson.
Hello.
And we've got a special guest with us. We always enjoy the intelligence brought by our friend Jeff Smith with Transformational Real Estate Investing. Jeff, so great to have you.
Yeah, thanks for having me. It's always fun to hang out with you guys for an hour, and it goes so quick. We doesn't seem like we ever have enough time to get everything on our minds out to everyone. So
Yeah,
absolutely. Well, I'll get out of the way and let Wade tell a little bit more about our long-term relationship we've had with Jeff Smith, and we'll get to the latest things on the market. But let me offer this disclaimer first. This presentation that we offer is just for general information only, and no information or estimates provided here represent any determination on investment performance. So by attending today, basically you're saying that we're here to provide value for you, but we're not held liable for any information that you might apply to your real estate portfolio. That being said, let me turn it over to the guys.
Thank you very much. And very excited about Jeff. You know, we've known Jeff for maybe 10, 15 years now, but Jeff has made a move recently, and I'm very excited about the group he's working with Transformational Real Estate. So Jeff, tell us a little bit about what you're doing and what you're working on over at Transformation.
yeah, you know, the founder of Transformational Real Estate Investing, Trey Stone, is when he teaches folks what he calls the transformational playbook. And it's a business model for real estate investing that I think is at the foundation of it. Its impact on the community is what's foremost, in the plan. When you provide your customers, your tenants in our case, with a with a with a home that is so much more than their expectations, it's almost impossible not to succeed. And the playbook that he teaches, I think, is so essential for a real estate investor, and any investor in residential real estate. And I'm excited to be a part of it.
Yeah, sounds like that principle. In order to get what you want in life, you have to help other people get what they want in life. So if you bring them a great property, then you can build wealth for your family, and it all works out. It's kind of a win-win for sure.
Oh yeah, it's wins all the way around.
Yep.
So are you guys doing business? Are you guys doing business in just Houston, in just Texas? Where are you guys starting out?
Well, our headquarters are in Houston, but the reach of the group is nationwide.
Awesome. Okay. That's awesome. All right. Well, as Jeff said, we often struggle to get through all the content that we would want. So let's dive right in. I'm briefly going to cover our value proposition. I want to hit a few key things. We do take pride in being a one-stop shop for hard money and permanent financing loans. We're also excited to be real estate lenders built by real estate investors, which means that we also, many of the people on our team, and me personally, I'm a real estate investor, and we want to take that knowledge and help you succeed. We also are take a lot of pride in our 5-star average customer service ratings. And I want to cover real quickly the products we cover. We focus on hard money, which is the money to purchase and repair distressed real estate, and then 2 long-term products to help you be a landlord, a successful landlord. And those are both conventional and non-conventional or non-QM loans. And we also offer those DSCR loans. They're excellent products that can be used both for you being a long-term landlord, or even on short-term rentals. So if you're interested in any of those products, we'd love to chat with you. Let's go to the next slide. And Houston, Jeff, I know you've seen this report. Tell us what you're thinking about here in Houston.
Yeah, there are some notable things, and I think you'll find there's a similar trend across Texas. And that's there are some things that are counterintuitive in these numbers. And what strikes me is you would expect there to be a drop in the sales price when you have such
Yes.
increase in inventory. And we've had a year over year. This shows a 23.5% increase in listings, the active properties that are available and on the market, and only a 10% increase in sales. And you're, over the course of the 5 years that you're showing, the first or the last pre-COVID year, only a 1% increase in sales, but a 17% increase in listings. And you've got a median sales price that increased 3% year over year and almost 40% over the 5 year period. You wouldn't expect that with such an increase in inventory. And so that's the first thing that's notable. And with regard to Houston rentals, another counterintuitive thing is that you would expect a drop in leased price with a 19% increase in total active listings. And now that's not shown here. This is you have an 18% increase in or I'm sorry, a 5% increase in leased listings, but in total active inventory in Houston, there's a 19% increase. And the thing that I focus on, instead of just the number of listings that the total number of listings, I like to look at, well, what's the median income of a tenant and what can they afford? And I haven't looked at in probably 6 months, but last time I looked, we look at renting to folks and we qualify them based on income at 3 times the rent. And if you figure that the median income in Harris County is somewhere in the $60,000 range for a household, not per person, that family can afford $1,800 a month rent. Well, the number of rentals available at $1,750 and below are just a fraction of the total rentals available. That's under 1,500 rentals available compared to almost 9,000 total rentals available. So if you're targeting with your rental property business, the working class folks, you've had a decrease in inventory year over year, not an increase, like is shown here. And so the rental prices have consistently increased in our area because of it, especially at that lower price point.
Yeah, that makes a ton of sense. And do you see, like, I know that in other parts of the country, the average rent rate is significantly higher, despite the fact that people are not necessarily making more money. Whenever we look at those at the end of this presentation, we'll look at the affordability index and the average incomes in certain markets, and they're really out of whack. And Houston is, most of the major metros in Texas are more attractive than a lot of the other parts of the country, considering the amenities and the job opportunities, et cetera. But how much more upward pressure do you think there can be on rents if there are so few properties that are in their range?
So I think from a longer perspective, say 5 years or so, there would be, I think, considerable upward pressure. From a short-term analysis, say 1 year, 2 years, I don't think so. But and I'll explain that here when we get to some information that I sent you, if that's included here. But a shorter term perspective, I think I think we could see some softening in the rental market, but um, long term, if there's a really great resource for Houston data, and that's the Greater Houston Partnership. And they have a chart on their website that shows the top 20 most populous metros in the country, and it compares their housing affordability to each other. And out of the top 20 most populous metros, Houston is the fifth most populous metro, fourth most populous city. We are the 19th. We're second to the lowest in terms of housing affordability of those 20 most populous metros in the country. And
Right.
at the rate that we are growing, there's no there's no way we can sustain the affordability that we have
Right.
so far.
Too many people are moving in. Yeah. It's just
Yeah.
Yep.
So I have a question for you, Jeff. So you opened up with the fact that, like you said, there's a lot less sales, a lot more inventory. The days in the market are obviously up since last year, but they're down since COVID. But the prices are, so with all those things being said, you would expect prices are dropping. What do you think is the biggest factor as to why that is not happening?
Yeah, that's interesting. Locally, I think that it really has to do with employment, right? I mean, the economy has held strong. Employment has been strong. As much as the Fed is trying to, as they have been over the last couple of years trying to fight inflation. Um, One of their goals has been to to I this is my interpretation of what they're doing. I don't know that they have said this outright, but is to lower the growth in wages, to slow down employment, so that so that spending spending slows down, to bring inflation down. And I think that the economy has been stronger than anybody expected. Um, Notably employment in Texas, right? One of the reasons that our population is growing is because we're attracting so many businesses that want to move to Texas, and startup companies, and that's another great notable thing about the General Houston Partnership website. They highlight all of these things with, which companies are moving here, which great companies are new and notable, and it's just a really interesting read,
Mm,
especially for somebody like me who's so heavily invested in the Houston market.
for sure. Yeah.
Yeah.
You know,
Last thing I'll ask is, I'm sorry, just real quick. So if I'm a flipper, I mean, if you're a landlord, I think there's some slides down the road we're going to see that are going to be very encouraging. But if I'm a flipper, it would seem to be that you can still flip properties, prices are still strong. You just may need to account for a little bit more hold time. It may take a little bit longer to sell your properties.
Oh, definitely, and the um, the New York Fed did, earlier this year, they have a little tracker that predicts the likelihood of a recession over the next 12 months. That spiked earlier this year. And so if I'm a flipper, I am going to look for more favorable margins, or look for easier to sell properties. So if I'm buying a flip property at a higher price point, I'm going to need a much larger margin than I would have 2 years ago, um, just 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 for my own peace of mind. Now, maybe not so much if the property also works as a rental property. Maybe I can continue with my normal margins, because the exit from that property is going to be pretty easy if it can be either or. But on most of the flip properties that I see, they usually are at higher price points than what I like to buy as a rental property.
Yeah, I think I think a sweet spot is if you get just out of the range of what landlords will purchase, because if landlords are going to buy it, they're going to pay more than a flipper normally
Right.
would be able to profitably purchase. So that, that line of demarcation is often somewhere around 350, 375, maybe on the high side, maybe 400. And then, I also think that in order to still have the option of keeping it as a rental, that sweet spot's probably somewhere between 350 and 550, where you could still at least break even, right? Once you start to get into higher price points, you're almost only having one exit strategy, which is selling it.
Yeah, definitely. Now, those are Houston numbers. I mean,
Yeah,
if somebody's sitting here in San Francisco,
Dallas,
those numbers don't make any sense.
for sure. Yeah, for sure. I did want to talk just a little bit about, and Jeff, you said that you need to be worried about holding it longer. It is interesting. The days on market from October 19th, 59, it's 51 today. It's actually 8 days less, and it's only 4 days higher than last year. So Houston is moving through pretty rapidly compared to pre-COVID, which so just something to keep in mind. I don't think the numbers are that bad at the moment. Not that they don't need to keep an eye on things, but that's still relatively quick. And still, the 6 months of inventory is kind of that line of demarcation for buyer and seller's market. We're at about 4.4. Now that the inventory is higher for sure. Like that as Jeff started off with the comment, it's a good bit higher, and that's why that months of inventory number is higher. But a couple things, if you look at average sales price year over year, Houston is up 5.2 and 2.7 on the average and median sales prices, up 42% and 40% since COVID. But it is interesting, and this was not always the case over the last few years, but if you go through the other cities, which we will, those two numbers on average and median sales price increases are better than any of the other major metros as we progress. So maybe it's a good time to hop into Dallas. All right. So in Dallas, going over those average and median sales prices, you can see there was a time whenever Dallas was pulling back a little bit, but now it's up 2.3% year over year, 0.5% on median sales price, not as strong as Houston, but of course, from the pre-COVID rate, significantly greater than Houston or any other major metro at 61 and 51%. That months of inventory is below the Houston number. Days on market, basically in the same range. But the lease rates are something that's really up over time. That average lease rate from pre-COVID up 32%, although flat year over year. What else are you guys seeing in the numbers there in Dallas?
Well, from my perspective, it's a very similar trend, right? Listings are up 30% year over year, 8% since pre-COVID, but with sales not rising as fast as inventory, your intuition would say prices should be down, and they're not. So the question is how in the world is that possible? And to Jeff's question a minute ago, I think it has to do with how strong Houston and Dallas in particularly, but Texas as a whole, is doing with regard to strong employment.
Yeah.
And the influx of out-of-staters.
Yeah, migration.
Well, like those numbers don't scare people from a lot of the markets where they're coming from. So I think that is part of it. Like the locals are like, hey, what's going on? All these prices are high. But there's so many people moving in from out of state where they see a house for $500,000 in Dallas and they're like, that's a great deal. Let's go.
Yeah. No,
They may be propping these numbers up.
It's definitely possible. But I did a presentation a week ago where we looked at migration specifically. And the interesting thing about the migration patterns, the net domestic migration. This is excluding, you look at population increases in Houston and in Texas, they're up, and they're up considerably. But even if you strip out the net of births minus deaths, and you strip out international migration, and you just look at net domestic migration, Texas and Florida are attracting so many more people than than the other larger states in the country. The other larger states are losing people.
Mhm.
But what's interesting to me about the Houston area in particularly, the net domestic, while the population is growing in the Houston metro, the net domestic migration in Harris County dropped,
Hmm.
but it grew in every county that is adjacent to Harris
Mhm.
County. So
Yep.
the Houston
That's,
metro
we might have read the same article.
is
We might have read the
Uh,
same article because I think there's a slide coming up that'll talk about that,
perfect.
about
Okay.
exactly
All right.
what you're talking about. Yeah, for sure. You,
So
you stole the
people are
thunder,
moving to
but
the
you're
suburbs.
exactly right.
Well, I'll hold off and we'll talk more about that then.
Yeah, we'll do
Yeah,
that
yeah,
in a bit.
sure.
Well, let's dive into two areas that are performing better. I think Houston and Dallas, and then it's a little bit of a different story in San Antonio. Um, the median sales price is down 3.3% year over year, down 2% on average. The growth from pre-COVID not as large as Houston, certainly not as large as Dallas. But honestly, if you look at the months of inventory and days on market, that's where you can just see that market's slower, and that's been the tale for some time now. But 5.1 days, it's the first time in some time I remember a major metro in Texas approaching that 6 month line of demarcation for buyer and sellers market. So it'll be interesting to see if that trend continues. Although we have seen a lot of articles talking about the long-term vision for San Antonio being very strong over time. And I think it's primarily because the affordability in San Antonio is fantastic compared to Dallas, Houston, and San Antonio. I think the average person will see it a little bit in San Antonio makes the same amount of money as in Houston, but the homes cost significantly less and the rents are significantly less as well. So a lot of growth potential there over time, although we're not seeing it at the exact moment right now. Anything else jumping out here, gentlemen?
Well, I mean, I would expect that price reduction to have been even more, considering the increase in inventory. But the sales numbers are strong enough to keep that from happening. I will say this, that I do believe that San Antonio, um, while it's the seventh largest city in the country, so it can stand alone. Um, so I don't want to insult anybody from San Antonio by saying this, but San Antonio could easily become a commuting point to Austin.
Mhm.
And I mean, it's as far away from Austin as some Houston suburbs are from Houston. So, I mean, heck, my Houston, yeah, I, s- I live out in the country halfway to Dallas, but I happen to be in Houston today. My Houston house is really in between Tomball and Spring. And the commute for me, if I had to go downtown from here, wouldn't be all that much different from going, northeastern San Antonio to Austin. So
Yeah.
I can see all those two markets getting wrapped up into one in a few years.
Almost like
It's
a
funny you say that.
DFW, right? Almost like a DFW.
Yeah, absolutely,
Their
yeah.
numbers are almost identical. Like if you look at the stats, their days on market are within a day. Their months of inventory are exactly the same. Their five prices are exactly the same as far as the increases. Like to your point, their stats are oddly similar.
Yeah, let's hop over to Austin. I mean, obviously the price point is exponentially higher and the average
Yeah.
income is significantly higher in Austin, but they are closely correlated, almost like to Jeff's point, like downtown or the more affluent areas inside the major metro, and then in some ways a suburb, right? Where some homes in the suburbs cost less, have significantly lower average price per square foot. The average income may be less as well. So that's a really good comparison. I haven't thought about it in that exact way, but it does make a lot of sense.
So months of inventory, 5.1. Days on market are 70. These, if Jeff, you tend to look at the sales number and the listings number and how they kind of correlate. And this is the most obscene of all the markets, with the increase in listings versus the decrease in sales for sure. I don't know if do you have any other insights into Austin? I don't know if you guys see a lot of deals coming out of there, maybe some multifamily stuff.
Not so much. Generally, I would say, in any market, for what we do in pursuing workforce type housing, if you get on the freeway and you follow all the dirty pickup trucks home, right? And where do they get off the freeway? And in the case of Austin, a lot of times it's a hefty ride, and so you're going to be in the exurbs before you find that kind of housing. And maybe, and I think that's why you're going to get to a point where towns and cities that are an hour and a half away are at some point incorporated into the metro area.
Yeah. Jeff, you made a great point. I'm just going to walk through these real quick. Total increase in active listings from pre-COVID. Austin is an 81.8% increase. San Antonio, 38.8% increase. Dallas, 8.6%. And Houston, 16.6%. So, I mean, in Austin, that is a shocking number of listings at the moment. But, it was the absolute hottest market in the country in the heights of COVID. So many huge tech companies were moving from the West Coast and other parts of the country into Austin. Great jobs, and people were just massively overpaying for homes. The days on market was absurdly low. Everything was getting multiple offers well over ask, and it's just been a total reversal. And I think was somewhat inevitable. It went up so much so fast that had to happen. But really, Houston and Dallas in particular never had that big of a run up. So I think it's a little more predictable that they would not have nearly as far to come down whenever rates went up.
Fair enough. Yeah.
All right. I think this next slide is one that you sent in. So Jeff, why don't you walk us through this?
Yeah, absolutely. So for the last couple of years, anytime I'm talking to real estate investors, the number one question always has interest rates at the root of it. And at first, for example, back in 2022, when the Fed started increasing rates, the question was about cash flow, right? Cash flow started to drop. Higher rates equals higher payments. Higher payments means lower cash flow without any kind of rent increases. And so a lot of people waited. And those people missed out on much bigger equity captures and much faster appreciation than the people who stayed active and stayed with it and continued to invest. And so, what is it? A month ago, the Fed reduced the Fed funds rate. It may have, maybe that's the first in several cuts. And so the subject of what I get asked about has changed from, what about cash flow to, well, what does this mean? And I'm not, not necessarily the one to ask to interpret what the Fed means, but I am a longtime real estate investor who has paid attention to this kind of stuff, and I do make my own personal investing decisions based on information like this in part. And so, so I looked at it, and this chart is basically my lifetime, right? The first day of this chart is the day I was born. And And if you go to the St. Louis Fed's website, for a lot of their charts, you can pick the start date, right? So I just picked my lifetime. What is the what what is the Fed funds rate done over my lifetime? And so that's what we're looking at, right? And so it rose for a couple of years, and then now we've had a rate cut. So for Grins, if you superimpose the 30-year mortgage rate on the same chart, and if you go to the next slide, you can see that. You, you can see that two things that come to my attention. First is that mortgage rate cuts a lot of times precede Fed activity. And the reason is bond investors move faster than the Fed. And since mortgage rates move with the 10-year treasury, I pay more attention to that than what the Fed might do or what the Fed might say. And so that's why mortgage rates moved before the Fed funds rate moved, when that moved last month. The second thing is that I would bet that the Fed members who vote on what to do about rates see something in their data that they find concerning. And if you look at the shaded areas in the chart, those are recessions. And what direction did rates go right at or right before the onset of each recession? And you can see clearly that the Fed started to drop rates right at or right before each recession. So the answer to the question of what do I think it means is I think we're possibly on the cusp of an economic turndown. How deep, how long that might be is probably debatable. But if you click onto the next slide, the New York Fed, and this is what I mentioned earlier, publishes a probability meter. It spiked earlier this year, and it's about recessions. And so it raises the question, does this mean you should wait to invest? And I don't think so at all. My investing pattern is that I'll normally make, I don't know, 3 to 6 or 8 new investments a year. Now, those might be houses, they might be passive investments. I've done a few IRO deals in multifamily. An example would be last year I made 7 new investments. This year I have made 4. But during certain periods of extraordinary opportunity, let's say, I step it up considerably. After the dot-com bubble, I bought like 4 dozen houses. After the great financial recession, another few dozen. Post-dot-com bubble, it's the one I mentioned earlier. I skipped the COVID recession, and I shouldn't have, but that was just because of stubbornness. Instead of investing more heavily, I kind of deleveraged myself. But if a recession does occur, as this indicates that it might, I'll step it up again and start investing as aggressively as I ever have. It doesn't mean I'm stopping. It just means I'm going at my normal pace, right? Whenever there's a good opportunity, I buy. And but this time, if there is a recession, I'm 52 years old, as you could have seen from that chart on the previous page. Because of my age, this might be the last cycle like this that I experience as a very active investor. But I also believe that I'm at the top of my game right now. And so if another extraordinary opportunity comes to pass, I will be very aggressive. Now, here's the thing. Here's the caveat. This time, if there is a recession, I don't think the distress will come from your typical single-family homeowner. I think it'll be a surprising source. So if you want to look at my thoughts on that, let's click through to the next one. The first thing is the mortgage credit availability index. This is published by the Mortgage Bankers Association every month, and it's a gauge of how prevalent the mortgage supply is. And you can see that in the most recent 15 years, you guys in the mortgage business have been very conservative relative to how you guys were in 2005, 2006, right? And you can see that you guys were very aggressive lenders before, and right now this index is just a fraction of that. So that
Yeah.
means that you guys have been a lot stricter than you used to be, right? Leading up to the great financial crisis, you guys fixed that problem, right? And you can go ahead and click to the next one, where people who could get anybody, where you couldn't just be breathing to get a mortgage. And that's reflected in the foreclosure rate. You can see here that the foreclosure rate is super low relative to where it was back then. And you can click through again. And you can, and this one is, 40% of homes now are unleveraged, period. 40% of houses. So, if there is a recession, is it going to be your typical homeowner? 40% of whom don't even have a mortgage, and the others who you guys vetted and much more strictly than you did leading up to the great financial crisis. And if you click through to the next one, most of those people have considerable equity and below 5% interest rates. So your typical homeowner, I believe, has some insulation from a recession, unless, of course, it's a really long and really deep one. So
What is this chart, Jeff?
this one is the equity that folks have in their home. So you can see that, or their loan to value, I should say. So
Okay.
you can see that over 8% of folks have 50 to 54% leverage
I
on
see.
homes. And the number of folks who are above 90% is super low. All right, above 90% leverage on their home. Those are the people who are susceptible to a downturn, right? People who
Yeah.
are highly leveraged. And it's just not the case that a lot of these folks are vulnerable, who have been the people you guys have loaned money to over the last 15 years. It's not those folks have low rates. They have high equity. So if you click to the next one, the question is, all right, well, who gets hit hardest in a recession? So I just asked Google that question, and here's the results page. The answer: construction, retail, service workers, people with jobs who, that depend on other people having disposable income. Well, who are those people? Our customers, right?
Yeah.
Our tenants. So that leads me to a conclusion. Where will distress come from? And believe it or not, I think that it's going to come from real estate investors, not the properly trained folks, but the people who are accidental rental property owners, right? People who may have inherited a property or kept a property they couldn't sell, so they're not trained. So poorly trained or untrained investors, over leveraged rental owners, undercapitalized rental owners, right? Folks who don't keep enough. You guys require people to have a reserves when you lend to them, right? Well, if people then spend all their reserves after you guys make a loan to them, then those are people who are vulnerable. Flippers who were caught with short-term financing and not a strong exit, to your question earlier, and landlords who have loans with balloon payments are potentially vulnerable. So I think that the opportunity, if there is a recession, and it's no guarantee, right? That New York Fed meter was at 50 or 60%, right, is what it popped up to. So I think that we should look to folks who have the opportunity is going to come from the untrained or the poorly trained or the accidental rental property owner. And so last month, when I went through all of this, we did a little workshop on how to find those people and how to target them. And so I think that I think that provided if there's a recession, and provided it's not prolonged and deep, that this is where we should look for opportunity.
That's great strategy.
Some very good insight, Jeff.
Yeah,
Thanks.
for sure. I have a couple things to add to that. in the more traditional stock and bond investing world, there's something called dollar cost averaging, right? Where it just means you put in a certain amount of money. You're dedicated to putting in a certain amount of money at all times, because if you are only waiting on something to happen, uh, if you're only waiting on something to happen, then there's nothing, like you may never end up buying, right?
Yeah, absolutely. Right.
So you miss out on all opportunities, and you never know if things are going to go up or go down. But if you're constantly putting money in, and then you take advantage whenever things do go bad, but you're consistently adding to your investments, that is the right way. That is the right approach. And if you deal with anybody who's done really well in the stock market, I do invest in the stock market some. I believe a lot more in real estate, and I'm more heavily weighted there. But that is a very common strategy. So I think it's very similar to what you were saying earlier.
Yeah.
The other thing, go ahead. I'm sorry.
No, I was just going to reiterate. Yeah, I never stop looking for opportunities, which means I buy 3 to 6, 9, and new investments a year. But when there's extraordinary opportunity, um, it's go time for sure.
For sure. The other thing I was going to mention is you covered like the availability of credit and how much more strict we are, but I was going to add a little bit more color to that. Whenever in 2007, there were products that went to 125% loan to value, not in Texas necessarily, but across much of the country, 125%. That's a non-existent product today. There were negative amortization products for primary homeowners. That's a non-existent product today. That actually meant every month you paid your mortgage, balance went up instead of coming down. Incredibly low FICOs, down into the 500s, with relatively standard products, and no income doc program. So you did not have to prove your ability to pay on a primary residence. So
Yeah.
nowadays we have
Arms too.
I'm
Tons
sorry,
of arms.
tons of arms,
Tons of arms that don't exist now.
Yeah,
Or they exist, but just they aren't being used.
right. So there was, it wasn't only that that we were more strict on evaluating an individual borrower, but the products were so risky, and if something went wrong, because everything was on a high LTV, or people had no proven ability to pay, or they owned so many properties without ever proving their assets or anything, that it was just a disaster waiting to happen, because so many more people who were not credit worthy had credit, and then the products they had were incredibly risky. So to your point, I think we're in a vastly different situation, both on selection of borrowers, but also the products that they've been provided. All right, let's go to the next slide.
Yeah, I got one quick question on that, because
For sure.
I was just going to ask Jeff. Well, you described one of the things that people don't have typically on real estate for single family or balloons, but apartments do. Do you think apartments will have the same types of risk that you described as a single family investors? You think better or worse or same?
I think the folks who are active multifamily buyers right now are going to get better deals than they have had the opportunity to buy in the last 5 years. For that reason, they're going to have they have these balloon payments. They have these mortgage maturities on the horizon. They have lower valuations in many cases because their taxes have gone up, their insurance has definitely gone up, and since they're evaluated on the income approach to value, they're 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 going to have cash calls in order to they're going to have to bring money to the table to refinance out of those um, balloon payments, balloon loans. So a lot of them are going to have to sell. A lot of them are going to become distressed properties, and the multifamily market could. I'm anticipating when I say a considerable buying opportunity, I am definitely including multifamily and maybe even predominantly multifamily.
Yeah, I think multifamily and commercial, they both have some of the same challenges. Single family property prices have been buoyed by end buyers, right? They're not looking to make a profit, and they need to buy a home to live in. Whereas both investors and then of course the lenders behind it, when they're making that net operating income evaluation, and interest rates have doubled, and then some other categories have gone way up. The valuations just aren't going to be where they were before. Yep. So we do have a couple other slides I did want to get to. We're going to try and get wrapped up. I do have a hard stop, unfortunately, at 1 today. You guys could carry on a little bit if you chose to, because I know we have a lot more to cover. But let's dive into some of these excellent markets here in Texas. You can see we've got Houston, Fort Worth, San Antonio, and Austin all listed. And these are, Jeff, correct me if I'm wrong, when we researched this a little bit, it was not just the top particular markets here, saying it's the top 25 or anything like that. But that being said, it's just a cross section of different markets across the country showing how the fundamental growth has gone over time. Is that right?
Yeah. So basically what they did was they looked at overall just growth in these cities. But if you look at the American economy, a huge chunk of growth is in two sectors, healthcare and defense. And like, well, that's not, somebody spending a lot of money to pay a medical bill or, making a lot of bombs. It's not really that sustainable. So they removed those two sectors and they said, okay, things basically at that point, the economy is pretty flat. And so these markets were the ones that when you remove those two portions of the economy, like which ones had really good population and job growth, like real job growth and population growth. And to your point, Jeff, Houston is on there, Fort Worth, San Antonio, and Austin. So, obviously there's some other markets as well. There's a couple Floridas, some Indiana, South Carolina. So it's basically like, hey, these are markets with strong fundamentals. There's no fluff in these numbers. These should be safer bets. Is really what it's pointing to. That makes sense.
Makes perfect sense to me. I mean, it looks like to me like if there's a Southwest Conference or Southeast Conference football team in the market, then 70% you got a 70% shot here. It looks strong to me.
For sure. Let's go to the next slide. This is kind of a heat map, color coded for population growth between July 2020 and 2023, where Texas population grew by very impressive 1.2 million. And if you look at the fastest growing counties, this is a lot what Jeff was talking about earlier. It's like it's not necessarily happening in the middle of nowhere, and it's not necessarily happening in downtown major metros. A lot of that heat map is heavily concentrated just outside of the major metros.
Yeah, this is the one I was referring to earlier, Jeff, to your point. If you look,
they
literally just surround all the big cities.
Yep. Absolutely. Yeah. And look at every county that touches Harris County. The growth is strong. And if you I was looking at on the Texas A&M site, which it used to be called the Real Estate Center at Texas A&M. They changed the name. I forget what they're calling it now. But if you look at their raw data, and you can strip out net domestic migration, and that way you're not looking at the international stuff. You're not looking at the net of births minus deaths, and you're just looking at where people are moving who are already here. The net domestic migration part, every county that touches Harris County has been growing fast. And so you look at that and you think, all right, suburbs and exurbs are looking strong, and sure enough, that's where people want to be.
That's where we get a lot of deals these days. Like Harris County is great, but I would say we probably get just as many, if not more, deals outside of Harris County than we do inside of Harris County, for sure.
Yep, definitely. Jeff, I know you deep dove this next slide. Do you want to walk through this one?
Yeah, so it's kind of a one of those grids that show things are they good and getting better, good and getting worse, and the opposite of that. a lot of stuff is very tight to that median line there. The one that I noticed that I don't know, Jeff, if you have any insight. The one that is the one biggest outlier is way over there on the left. Permits to household growth ratio. I thought that was interesting. That is the biggest outlier by a mile. And then earlier we are talking about mortgage delinquencies. While it is weakening, I guess in theory, it is still very healthy. And foreclosures is even more so. It's healthy and getting better. So it kind of validates what you were saying earlier about the lack of a recession coming up. Foreclosures most likely. But anything on any comments on the permits? Any ideas on where that's coming from? You think or not?
So yeah, we're not building a lot of spec homes, right? And we haven't since the recession. The thing for me is that there's a survey done every 5 years that looks at the cost of regulation in home construction. And the one that was done in 2021 determined that $95,000 of the price of a new home is in the regulations that's built in. And so that tells me that, all right, if you've got to spend that much money before you've spent anything on labor, on land, on materials, and it's just to regulation, how can you build something that is affordable to the working class and absorb that much cost and regulation? You can't. That tells me that what we buy and what we own is going to become even scarcer. And
Yep.
to your question earlier about Houston in particular being at the bottom
The
of
prices.
prices, we can't not build and absorb more
Yeah.
population and stay as affordable as we are. So my advice is to invest in this stuff as fast as you responsibly can. Get as much
Yeah.
of it.
Yeah. I think there's a slide coming up that shows new builds versus existing homes, and I think the existing homes are about to overtake the new builds.
Yeah, I will say I read an article a while back talking about the correlation between access to building permits and building codes and home prices, and I saw that just one example or a contrast is that for some time now, maybe better part of 2 or 3 years, on a monthly basis, there are more open new construction permits in both Houston and in Dallas than the entire state of California, as an example, and that's a very, very expensive state. If you can't add inventory without unreasonable regulations, home prices go up significantly. And that's one of the reasons why it's so economical here in Texas. Despite, having natural disasters that would lead you to think homes need to be built even more robustly. But I think that there's just less regulation, a lot more permits. Let's see. I think we've covered this one a few times. There's some other slides. This one here, I think, is a little bit more, this rental affordability slide. Oh, Jeff, we go one more slide, please. Yeah.
Yeah. So this, if you're looking back to 2000 as an index where they're all things being equal, it shows the increase in a high-end home, and they show you how they define a high-end home, but a high-end home versus an entry-level home. And I think to your point, both of you guys just hit on it. If you look, things are relatively close until I guess 14 and beyond, but it is getting obnoxiously disparate between the increase in the price for an entry-level home. And I think that just goes back to what you're talking. It's so expensive to build new homes these days. You can't afford, if you're a builder, you can't afford to buy them at a price point that would stay at that 100 index relative to the more expensive homes. which
Yeah.
pushes people into, which if I'm an investor, this is going to tell me people are going to get pushed into rentals because they cannot afford starter homes.
Yeah, which will inevitably also push up rents, as Jeff Smith said earlier. But that's a longer tail, right? That doesn't happen instantaneously. That next slide, it's kind of all on the same thought, Jeff. So if you want to wrap this.
It's the same concept, basically. It just shows the increase in monthly costs on a house that they want to buy compared to their current rent. And I was surprised that this is not the all-time high by any means, but it is significantly higher. I think I read an article. It's in the low 30s. It looks like back in the I guess the good old days, it was spiked all the way to 60%. But it is still significantly more expensive to buy the house you're targeting versus renting. There's a lot of factors and they go into that, obviously.
Mm-hmm. Next slide. I know this is in the same vein too, Jeff. Do you want to a quick summary on this one?
Yeah, it's basically the same thing. So the median rents on single family from loan applications, along with the median of adjusted mortgage payments. So how much higher the typical mortgage payment would be over the typical single family home rental each month. If you look at the left-hand chart there, estimated mortgage payments to buy the median home versus estimated rents. It's $2,000 to rent. Looks like it's roughly $2,600 to buy. So, the wider those numbers, like I said, look down below. I guess in the around 12 or 13, it was actually about the same after the GFC. But these days, it is significantly more expensive to buy. There's no doubt.
All right. I was interested to get your opinion on this, Jeff Smith. This is that's a shocking downturn on the new construction percentage of existing inventory, new and existing inventory. What do you think is leading to that?
Well, the home builders have been able to boost their sales by providing incentives, getting their buyers' mortgage rates lower.
Mm-hmm.
You've been able to buy from a builder with an incentivized mortgage that is a point or more in some cases below what you can get on the open market, and so builders have been able to boost their sales in that way. I think that a lot of that is related to some of the stuff that they had in their pipeline that was unfinished when rates started going up, and their pipeline their buyer pipeline started to dwindle, and so they still had the supply pipeline where it was. Well, their supply pipelines are now slowing, so they're not as desperate to make those same deals that they were making before, because I mean, frankly, they're not gonna um, they're not gonna increase their inventory when the demand pipeline is slowing. So um, now homeowners, on the other hand, existing homeowners aren't motivated necessarily by profit, right? These are folks who are putting their house on the market for other kinds of reasons, not necessarily profit motivated. Lifestyle choices, perhaps, right? Their family is growing, or in my case, I'm soon to be an empty nester, so this house I'm sitting in now will be on the market, and the one that I replace it with will be a much smaller property than this one. And so, that's not related. That's a decision that's not related to the economy, not related to profitability, not related to anything that the builders are motivated by.
Yeah.
And so I think that, we'll continue to see an increase in existing inventory or a stabilization of it while at the same time, unless rates fall and considerably and a slew of new buyers come onto the market, the builders will slow down as well.
Yeah. Jeff, I might let you to Jeff's run with this. I do have a hard stop, unfortunately for me, but I know we have a couple other things to maybe go through and we can wrap up with questions, et cetera. But really apologize. I normally try not to schedule anything right after this, but I do have to hop today. Thank you everybody for joining. And Jeff, as always, appreciate you joining. Great insight, my friend. Thank you.
All right, see, wait. So let's just skip to the affordability index towards the back there. I think it's these are all stuff we've covered in the actual markets. So the last thing I wanted to ask you about, Jeff, was the affordability index. There we go. So the interesting thing I thought was, if you look at, say, Houston, for example, right? The household income, you almost nailed it. The household income is $64,000 per year. And if you look a year ago, it was 65. So it is, the income's going down, right? But if you look at the home price, it was 335, now it's 363. So it is becoming less affordable. Do you have any I was just really surprised that the income has gone down, right? And
Right.
Houston's not the only market. I think I just looked at like El Paso, for example, it's a little bit lower. San Antonio is a little bit lower. There's a couple that are higher, but the median incomes are dropping.
Yeah, the thing that I wonder, do you know if this data is the metro area or just the city itself?
My guess is it's the city itself, because if you look at like number 68 and 72, they have
Yeah.
Arlington and Garland. So that leads me to believe they're measuring each city.
Okay. So I would venture to guess that for example in Houston, we talked about the adjacent counties growing in population. Generally speaking, the people who move are people who can afford to do so. And so some of your higher incomes may have just left the city and went out to the suburbs. That's a possibility. And so so that in and of itself is gonna drop income without necessarily, the jobs paying less.
Yeah, that makes sense. That makes sense. All right. I believe that is our last slide. Derek, do you want to hop back on and tell us who our winner is? And there we go.
Absolutely. So the winner of today's drawing for half off your next hard money loan processing fee is Caitlin Dazinski. Today's winner.
Congratulations, Caitlin. Way to
Caitlin.
go. I will have somebody reach out to you. So Jeff, I really appreciate you hopping on. If somebody wants to get in contact with you to learn about what you're doing, how would they do so, sir?
Send an email to jsmith@transformationalinvesting.com, or just go to transformationalinvesting.com and there are plenty of ways to get in touch with folks at our firm there.
Great, great. Well, thanks again, man. I really appreciate it. You're one of the best. Today was no exception. So really look forward to next time, and have a happy holidays.
You too. Thank you very much.
Thanks, everybody.
All right,
We'll
thanks,
see you on the
everybody.
next real estate market update. Have a good one.